So far, so good. Just give another couple minutes as people start to finish rolling in. I want to welcome everybody today. Thank you for joining us. It must be 3 o'clock. We are going to go ahead and get started. I am Tracy Leonard Warner. I am the Executive Director at Ryan House. I just want to welcome everybody today. I do want to let you know that we are recording today's session so that we can share it with our donors and supporters later. And we also know that some of you have already included Ryan House in your planned giving, and we want to thank you for that. We would like to welcome you as members of our new Open Hearts Legacy Circle. We're excited to kick off our Legacy Circle as part of our 10th anniversary. And so we are excited to do that. And if you are considering a gift to Ryan House, we'd love the opportunity to speak with you about the impact that a planned gift can make, both for our children and our families here at Ryan House. We will be honoring our new Open Hearts Legacy Circle members with special benefits and opportunities throughout the year. So watch for more to come, socially distanced, of course. Today's webinar is going to explore planned giving in our current environment. I'd like to welcome Doug Diehl and Patty Park with Northern Trust, and Stephanie Fierro and Lisa Paine with Jaburg and Wilk. Mark Schoenberg is also joining us today. He's going to share his family story and their connection to Ryan House. A heartfelt thank you to all of our panelists for donating your time today. We truly appreciate your help. We will have time for general questions about planned giving at the end, so please be sure to use that Q&A button at the bottom of your screen. If there's anything else that you need throughout, you can use that chat button, and Pepper is going to take care of that and watch what's going on. And we're just going to get started. We're going to start off with Doug. Let me share my screen. And I think if each of our panelists can mute themselves when they're not speaking, then we will be good to go.
Great. Thank you very much, Tracy, and hopefully everybody can hear me okay. I'm really delighted to be able to participate in this program this afternoon and really provide some insights on planned giving to benefit the Ryan House. They do such great work in our community, and it's such an important service. And as you'll hear from Mark later, it's just a wonderful organization and group of people and volunteers that make this work happen. So thank you for including us in this support. So we're going to answer some questions today on what is planned giving and how do you go about doing it. And so hopefully we can give you some insights as you contemplate where you might be able to put yourself in a role that could be supportive of Ryan House. So here we talk about, what is planned giving? Planned giving, I think the definition there is pretty good. It's really giving an allocation of resources and support of a nonprofit that's gifted during a person's life or upon their death. It can be part of your overall wealth or estate plan. And the elements of the planned gift that we often think about, it's usually coming from assets that have been accumulated over your lifetime. Many times you might have accumulated stock in a company that you work for. I think of large companies or employers here in Arizona like Intel, for example. We've had Honeywell and Allied Signal and others. And many people have moved here to the Valley from other locations, and they've accumulated their wealth in these large companies and have these large concentrations of stock. Maybe that could be part of a planned gift. It's typically usually larger in scale. It's not just something that's part of your annual giving or your tax credits and things like that. It's something that's a little bit more thoughtful and measured. And typically it's going to be a major gift that will have a big impact on the organization. It could involve a legal instrument, and the folks from Jaburg Wilk will talk about what that might look like. It might have some tax planning involved in it as well. And typically it may span a number of years, or it could be something that's part of a larger pledge or a capital campaign. And so those are some of the elements that we see as part of a planned gift. And hopefully you're working with some of your advisors or financial planners to help provide some guidance around what would be an appropriate planned gift. The next slide is kind of thinking about, am I a good candidate for a planned gift or planned giving? And some of the things that you might think about, if you're a longtime supporter of an organization, you would be an ideal candidate to make a planned gift. You know the organization, you're familiar with their purpose and their mission, but you want to have a more long-term and thoughtful impact for the longevity of that organization. You're interested in creating a much larger legacy, maybe for yourself or for your family. We see a number of families come together and think about these types of decisions for planned giving as a family, and it really helps maybe the children and the next generation get more involved in a philanthropic endeavor like that. Do you have sufficient assets to support such a gift? And again, working with your financial planners or advisors, you'll have some ideas on whether you can do that and what that appropriate amount might be. And then the other part of it is, really, can your assets be used for these charitable purposes, not just for an estate planning gift or something, but it will have a long-term impact on that organization. Is there a specific need that your planned gift could help impact? The next thing you might look at, or a question, is, will my giving make an impact? And I think the absolute question or answer to that question is absolutely. Any planned gift will have an impact. And this chart kind of shows that you might be surprised to see that of the $450 billion of gifts that were made in 2019, nearly 70% came from individuals. I often think that it's the corporations or the foundations that make large planned gifts, and it's really not the case. It's individuals like yourself that do. And over a third of those gifts went to religious organizations, in their community, as it's kind of an area that they go to. But a significant number of gifts are going to our social services groups like Ryan House. And then the last question I'm going to look at is how much should I give? And hopefully, as I've mentioned, you're working with a financial planner or advisor. Here at Northern Trust, one of the things that we do is we've got a software tool that we use called Goals Driven Wealth Management. It really looks at our clients' assets that they have. We want to make sure that they have allocated resources to fund their lifestyle for the rest of their life, to also handling discretionary spending that they might have, as well as commitments or goals that they have to their family. And one of the key areas we look at is that fourth area of philanthropic goals and giving. And we want to make sure that there is plenty of assets to take care of their other goals and objectives. And with that sufficiency, then they can be more thoughtful about how they can be strategic in their financial giving. I think, Patty, this might be an example where there's so many different ways that you can make a planned gift. How do you even come about choosing what the right gift is, or how to do that?
Yeah, well, Doug, I've worked with one client in particular. I just wanted to kind of raise him as an example. But he's made a few planned gifts already, and he's probably not done. He has an eye condition similar to macular degeneration, and he's being treated at the Cleveland Clinic when he's back in that part of the country. And so he's already looked at contributing a life insurance policy to the Cleveland Clinic so that they'll get the death benefit when he passes. Similarly, he has a home that he really no longer uses back in a part of Ohio where it's really close to a liberal arts college, and the college would love to have the home for their president's house and for entertaining. And he's done something to sell the home to them at a reduced price. So, that's something that's out there, just again, to kind of show the variety of vehicles that are out there. And then he's also planned upon his passing in order to get naming rights on a building from where he went to college, which was the University of Michigan. He's going to leave them $5 million for the honor of having his name on a building. So again, all kinds of flavors of different ways to do planned giving. But some of the questions or the thought process that I like to go through with folks when they are considering a larger planned gift, if we talk about what assets do they have, because usually, I think, Doug, you had mentioned, it doesn't really come from a person's annual inflows. It doesn't come from their salary, not often anyway. It usually comes more from assets they've accumulated over their lifetime. So we'll look at, do they have collectibles, maybe an additional home? Do they have appreciated securities that maybe they don't need the income from? It's really a very creative area. And so, I like to really get my understanding of what does that person have that could be a good planned gift going forward. We talk about what assets are they not using currently, and what assets do they feel they could give away and not really feel that they were missing anything. And again, all of this is framed in the context of, Doug, you had alluded and you were spot on. It's all framed with, we want to make sure that you're able to cover all of your life expenses before we look at doing something like this. But some people are willing and able to give an asset away, and they don't need anything more from it at some point. And then there are some vehicles that we'll look at here in a little bit that give the donor a cash flow stream back during their lifetime. And sometimes, that just feels better to a donor. And so that's why it's really important to have a conversation about what you want your planned gift to do and what you might need in return for it. The same way, we'll think of the tax deduction that a certain vehicle might generate, because for some people, it's important to get as large a tax deduction as possible for whatever type of giving they're considering. And so certainly we want to be very mindful that they're getting the largest tax deduction for the assets that they're prepared to give away. And also time frame, as I had mentioned with the client that I'm fortunate enough to work with, he has some gifts that he's already done during his lifetime. So he was ready to part with those assets, ready and willing to part with those assets now during his life. And there's another larger gift coming when he passes away. So, kind of thinking of the timing, it's nothing that you need to actually give the asset away today. You can just kind of get the structure in place and the plan in place. And also it's good to have good advisors around you, whether that's your CPA, someone working at Ryan House, someone working, at one of the law firms here in town, or Northern Trust, or whoever it might be. you need good advice when you're considering this kind of a gift. You know, annual giving is great, and a lot of us do it, writing checks or giving appreciated securities, but there are so many other moving pieces when we start to look at planned gifts that we want to make sure that we have good guidance in place and people are making educated choices. And there's another piece beyond the plan giving, the CARES Act, and some of us probably have heard of the CARES Act, but on the next slide, the CARES Act passed in March of this year, so just a few months ago, and there were some excellent opportunities in here for folks that are charitably inclined. And it boils down, the opportunities are kind of in two buckets. One bucket is for the people who itemize still on their tax returns. And again, the standard deduction amount increased quite a bit a few years ago. So some of us may have been itemizers, but in the last couple of years, we've turned into individuals who take standard deductions. And what the CARES Act brings to those of us who are in that bucket, where we just take the standard deduction, there is now a $300 above the line tax deduction per taxpayer. So if you're married, we're looking at potentially $600 of a tax deduction, where before, in order to get a charitable deduction, you needed to be an itemizer. Not the case any longer. So the CARES Act brought in $300 per person for a tax deduction. So that's a great thing if you're not an itemizer. But if you are an itemizer, the old rules, and by old rules I mean before the CARES Act passed, the old rules would let you give up to 60% of your adjusted gross income, and that's, we'll just call it your income, 60% of your income if you were sending a check, writing a check or sending cash to an organization. You could give up to 60% of your income in any one year and get a tax deduction for that. But the CARES Act for 2020 only brought in something where you're able to give up to 100% of your adjusted gross income, and you get a deduction for that amount. So it's actually possible in 2020 to reduce your taxable income to zero by making a larger charitable gift equal to your adjusted gross income. And so I've had a few folks express interest in that, you know, and these are folks that maybe have been paying taxes for most of their lives in higher brackets, and they've always sort of in the back of their mind thought they wanted to do some kind of a planned gift. And this is now giving them the opportunity to do that when they're getting the tax deduction this year. They're going to, you know, make a cash gift that's large and hopefully eliminate all of their taxable income. So great stuff out there. But again, just a couple caveats. It has to be in cash. Marketable securities doesn't count. And you can't give it to something like your donor advised fund or your private foundation. And we're going to talk about exactly what those types of vehicles are. But it's really just cash to an organization like Ryan House. And it would be possible to really reduce or even eliminate your tax burden for this year. And the next thing that we're going to show you is just a continuum. And this isn't even, when you see all of these words out there, this isn't even comprehensive. This is just a good survey of charitable vehicles that are out there. So we have the simpler vehicles where maybe all that you need to do is sign a form that a financial institution might have, up to something that's a little bit more complex, where you may need an attorney to help you get a document into place, or you're maybe looking at some non-marketable securities, so a private company, some stock in a private company, kind of runs the gamut from pretty easy to do to you need some more outside assistance in order to do that. And Lisa, I'm going to turn things over to you now because you're going to drill down a bit on a few of these.
I think I'm unmuted now. Thank you so much. Yeah, and you know, Stephanie and I work as a team, part of a team over at Jaburg Wilk, and we always like working with financial advisors and CPAs if clients have them, just to ensure that our clients' needs are being fully met, both now during their lifetimes and then after they pass away. I echo and second everything Patty and Doug said about, you know, working together and getting advice from people who can help you out and make sure, you know, your plan is being looked at from many different angles. One more thing before I jump into beneficiary designations is that I just want to stress the importance of properly identifying your charity in your documents. It's important to have the correct name, address, and tax ID number listed in your giving documentation, because you want to make sure that your bequest is going to the proper charity, and that when the time comes, people are going to be able to identify exactly which charity you're referring to. Now on to beneficiary designations. One benefit, as Patty alluded to, for beneficiary designations is that they're very easy to implement. You could normally use a form that's provided to you from the financial institution where the assets are held, which means you won't be required to draft new legal documents. And then beneficiary designations can be used for many different types of accounts, retirement accounts, such as IRAs and 401ks. They can also even be used for checking and savings accounts, many times for different types of brokerage accounts. There can be a tax advantage to designating a charity of a beneficiary of a tax-deferred account, such as an IRA or a 401k. Neither you, nor your estate, nor your heirs would be required to pay taxes on any sort of charitable donations from these tax-deferred accounts, which means that Ryan House could have the full benefit of the value of those plan assets. One more benefit for beneficiary designations is that they're not all or nothing. You can identify Ryan House along with other beneficiaries, such as your family members, on your beneficiary designation forms. And life insurance, there we go. One great way to give to Ryan House is to list Ryan House as a beneficiary of one of your life insurance policies. As with any beneficiary designation, one pro is that they are revocable, which means that if your financial situation changes during your lifetime, you can amend your beneficiary designation to meet your current needs and the current needs of your family. In addition, with your life insurance policy, if it's paid in full, you can identify Ryan House as both the beneficiary and the owner of the policy. And then you could receive a tax deduction for the value that you've paid into the policy or for the current cash value. When you do that, Ryan House would have the benefit of either taking the cash value of the policy now, or they could choose to wait for the death benefit later. And now I'm going to turn it over to Stephanie to talk a little bit more about what we do at Jaburg Wilk.
Sorry, I thought my space bar was going to work to unmute, but I wasn't apparently on that screen. And I have to apologize to all of you out there watching. I'm having a little bit of a vocal issue today, but I will make my way through these and maybe a little bit quiet during the Q&A, but I'm happy to be here and helping out today. So I suspect that many of you may be fairly sophisticated or have done this before. So I don't want anything that I say to be remedial, but we want to make sure that we cover everything. So one of the things that Lisa was saying are really nice options, because as she mentioned, you can usually accomplish changing the beneficiary with a form provided by the financial institution themselves. And so you don't have to change your underlying estate plan documents, which if you've done them before, you may not be too keen to redo them too quickly. And so that's something that allows you a little bit more flexibility. But most of you should have created some sort of an estate plan. And when we say estate plan, I'm talking about a will, a trust, typically involves some powers of attorney. And with the will and the trust is where you can make gifts designated to charity. And I will absolutely echo what Lisa said. It is really imperative that the charity is designated properly in your documents. So if you do have documents, I would encourage you to go and brush the dust off and make sure that they actually do specify the charity that you intend. If there is not an EIN number, it is usually my recommendation to include that. There are different charities around the country that may have the same name. And depending on where you're living at the time, it can create confusion. And I have unfortunately seen that happen before. So to avoid that, let's make sure it's as specific as possible. And so you can do all sorts of things. You can be really creative in your documents. You don't have to be, but you can be. And most of these documents, your will and your trust, typically when I say a trust in terms of a basic plan, is going to be a revocable document. So it's something that allows you a lot of flexibility to change beneficiaries, to update them, to increase amounts, to do whatever it is that you might like. And so you can recognize a charity in those documents. And they can also take the form of the specific beneficiary designations like Lisa alluded to. If you do want to change your will or your trust, then I beg of you, please do not handwrite changes onto those documents. That does create a bit of an issue when it comes time to administer those things. So although I am biased in saying this, I do recommend that you go back to your estate planning attorney to have them formally make those changes for you. Also, it's important to keep in mind whether you want to designate that your gift be made for a specific purpose. You have the ability to do that. If there's some specific thing that Ryan House or a charity is doing that you really want to support more than just general purposes, you can specify that. Of course, generally speaking, the easiest gift for a charity is anything that's left to them without restriction or with some sort of a general purpose allocation, because it allows them to apply it as neatly and easily as possible. The other thing to think about is in terms of the flexibility, even if you don't feel that you're in a position to make an outright gift because you believe that your family will need the funds, consider naming a charity as what we call the common disaster beneficiary. Okay, I like to call it the apocalyptic clause. It was a little bit funnier before we were living in COVID-19, but in the event that there are no beneficiaries in your line that are alive or willing to take. Remember, these are gifts that you're making. No one has to accept the gift. And if they decline the gift or are not available to take it, that leaves another planning opportunity. So if you have not considered who would take your stuff, if no one that you've designated is there to take, that's also a nice planning opportunity to designate a charity. I need a break. I'm not sure if I'm on the next slide. Okay, good. Back to Lisa.
You get a break, Stephanie. Grab some water. I'm going to talk to you about charitable remainder trust. And the charitable remainder trust, as you can see on the slide, is a type of irrevocable trust where you or your beneficiaries can get the income from the trust during your lifetime or for a set period of years. And then Ryan House would get the assets after you pass away or for the set period of years. You can contribute many different types of assets to a charitable remainder trust, including your appreciated stock or real estate and cash. There are two main types of charitable remainder trusts. One is the charitable remainder annuity trust, which distributes a fixed annuity amount to you or your beneficiaries each year. One potential con to this type of trust is that once the trust is set up and funded, you generally cannot make additional contributions to that trust. Another type of charitable remainder trust is the charitable remainder unit trust, which distributes a fixed percentage of the trust assets each year to you or your beneficiaries. A potential con to this type of trust is depending on the type of assets you have funded the trust with, you might have to revalue those assets each year in order to determine what that fixed distribution and percentage amount is going to be, or not the percentage, but what the amount it would be for that distribution. However, you are permitted to make additional contributions to the charitable remainder unit trust. Sorry, Stephanie, I think we're back to you. You are muted.
That's okay, I'm ready. Okay, so charitable lead trust, you just flip the charitable remainder trust on its head, okay? So in a charitable remainder trust, you are holding on to the benefit of the property during your lifetime and giving away whatever's left when you're gone. With a lead trust, you're doing the exact opposite. You're giving the charity the benefit first. And so you've got two main types of charitable lead trusts. Again, you have the annuity and the unit trust, but which Lisa did a lovely job explaining. But you have what are known as grantor and non-grantor charitable lead trusts. And so it depends on what your tax goals are, what you're trying to accomplish as to which one of these vehicles is going to be the right choice for you. In a grantor trust, you may or may not be aware, a grantor trust essentially means that you still have incidence of ownership in the property. And so that has different tax consequences for you. It also has different benefits and burdens. The benefit of a grantor charitable lead trust is that you get an immediate income tax charitable deduction. It is based on the present value of future payments. Okay, it sounds really, really convoluted, and it is. It's one of the more sophisticated kind of planning options out there. Interestingly, it's also one of the least often selected, but it can be really important, especially if you're going to have a big taxable income tax year. So if you're facing a particular year where your income taxes or income tax burden is going to be very high, this is something that you may want to evaluate with your planners. What you need to keep in mind, though, is while you get that immediate income tax deduction, you are going to be responsible for taxes on the income during the term of the trust. Okay. By contrast, a non-grantor trust, you don't get any immediate, that's the slide that we're looking at now, you don't get any immediate income tax deduction. But you are also likewise not responsible for the income taxes that the income generates during the term of the trust, because the trust is considered an immediate taxpayer, and the trust bears that tax burden. But the trust also gets the benefit of an unlimited charitable deduction for distributions. So while it sounds burdensome to the trust, it will usually net out really well. It also provides you an opportunity to reduce or eliminate gift and estate taxes. And you know, our lifetime exclusion amount right now is very high. And so that has been, and it has played into what people want to do with their planning, because taxes aren't necessarily a burden at the moment. But it is important to keep in mind that the current estate and gift tax law will sunset in 2026. Sorry, my hair's going crazy. Will sunset in 2026, and we will be back to prior levels. And so that could change dramatically. So it's something to keep in mind. One of the things that you need to keep in mind with these plans too is that they can be reversionary or non-reversionary. So reversionary just means that you can take back the benefit when the charitable lead portion is completed. You can bring that property back to yourself, or you can do non-reversionary and have that remainder interest go to a third party. One of the things that's, if you want to go to the next slide, I think there's a next slide. Kind of goes over the differences that I just mentioned. There is a note on the bottom about superclats. A superclat is a very complex vehicle. It's probably kind of above the level that we're trying to get to for this particular presentation, but we do want you to be aware that it exists. And it basically has all the benefits of a grantor trust for income tax purposes, but also has the benefits of a non-grantor trust from estate and gift tax, from an estate and gift tax perspective. So if you've really got a complex estate, it's something that you may want to just throw out there as a buzzword for consideration. With respect to any sort of charitable lead trust, it can be really helpful, because you have to remember you are giving away certain rights with respect to this property. And so you won't have the flexibility of being able to just change your beneficiary. And so one of the ways, though, that you can retain a little bit of that power without creating a tax problem is to actually pair the charitable lead trust with a donor advised fund. And with that, I send it back to Lisa.
Thank you. Donor advice funds are a great way for you to give money to Ryan House with over time, usually with little administrative burden to you and getting a tax benefit. How the donor advice fund works is that you donate assets to your donor advice fund, and then you can determine if you want to give money now to Ryan House or if you want to give it over time or at a later date. You can direct that Ryan House is the sole charitable beneficiary of your donor advice fund, or you can select multiple charitable organizations. And then the next slide, we'll dig in a little bit more about how they work. Your contribution to a donor advice fund is irrevocable. It's considered an irrevocable commitment to giving to charity. Specifically, first you make your tax-deductible donation to your fund. You can typically donate many different types of assets. You can donate cash and stocks, or even assets that aren't publicly traded, such as private business interests, cryptocurrency, private company stock. And as we talked about, you do receive an immediate tax benefit for the income tax donation deduction. Another benefit to your donor advice fund is that you get tax-free growth over time. You're not taxed on the growth from those assets in the donor advice fund. And finally, with the donor advice fund, you can choose to support Ryan House and other charities that you love, both now and over time. You can have it stretch out over many years, and as long as there are funds available. I know sometimes it can be difficult to visualize how you can make these different types of vehicles work for you, but Doug has a great example of a client who recently used a donor advice fund in a situation that worked for them. So Doug, you want to talk about that?
Thank you, Lisa. I think we're all familiar with some of the more highly visible foundations in town. Maybe you remember Bob Parsons when he sold GoDaddy. Made a lot of money out of that, and he and his wife formed a foundation. And all the complexities and legal requirements and accounting requirements that goes with that, that's an option. You can have your own private family foundation. Well, for many people, that may not be ideal. And a donor advice fund is a great way for people to kind of create a mini foundation, if you will, without all the headaches of all the accounting and financial tracking that needs to take place. You kind of offloaded that to another firm. And for example, the Arizona Community Foundation here in Arizona is a great example of that. One of our clients sold his business for about $3 million, and they wanted to set aside 10% of their proceeds into a donor advice fund for future charitable giving. They didn't want to give that 10%, that $300,000 away all in 1 year, but they did want the tax benefit for that to kind of match the year of the sale. And so by creating a donor advised fund, they were able to gift that $300,000 into that. They got their charitable contribution in the year that they made that contribution to their fund, their charitable fund. And then their family will get together once a year and they'll determine what charities they want to support out of that every year. And Ryan House being one of those, or several other charities that they, as a family, have decided that they want to contribute to. So that's a great way of thinking about how a donor advised fund might make sense.
All right, I think we're gonna, thank you, Doug. I think we're gonna welcome Mark.
Hello, and thank you. My name is Mark Sheano, and I had the opportunity to experience the Ryan House team in June of 2012 when my grandson spent the last week of his short life under their care. Not knowing what to expect as my daughter and son-in-law were going through a very difficult time in their life, after being told their 5-month-old son was nearing the end of life, we listened to all the caregivers at Phoenix Children's Hospital who had taken care of him for some time. And to the person, they all said, he needs to be at Ryan's house. We didn't know what Ryan's house was. Then he spent approximately 1 week at Ryan's house. And during that week, my wife and I were able to be there each day. We had free access. to lend our support to our son and our daughter-in-law. And you really didn't know what to expect, you know, going to a pediatric hospice. You know, you were thinking you were going to this dark place where kids pass away. And I was really taken away after being there and looking at just the facilities and how bright they were. And I know Tracy talked a little bit about this before this call, about how each room has a mural and everything was bright. There was a playground, there was a TV room, there was a pool. There was just this big positive vibe going on in this place where good things didn't always happen. So I was really taken away from it. And within several days, my wife and I had joined in, and we were reading books to the kids that are there for respite, that we found out, you know, you're seeing all these kids and you're wondering, are all these kids here on hospice? And they're all cheerful and they're talking to you, and then you find out they're there for respite. So their families could take time off and maybe take other family members to Disneyland. And we found our time was split between Benny, and then we would go back outside and I'd be on a playground with somebody, I'd be reading somebody a book, my wife would be drawing with a child that was there. And it was just a great, great experience. And what I found out, that a lot of these people we were dealing with were volunteers. I mean the staff, the nurses, they're paid, but the person that came in and with a therapy dog was a volunteer. The person that came in and sang was a volunteer. The person that came in and cleaned up the kitchen was a volunteer. And they all loved, all to the person, they all loved volunteering. And they would talk about how they couldn't get enough volunteer days a week or a month because the volunteer chart was always full. So you really learned a lot about the organization, what it was there to do, and it was a truly, truly inspiring week for me. And being the CFO I'm the one who's always asking 20 questions. How do you fund yourself? Who pays for you? Well, the volunteers didn't get paid, but there were people that need to be paid. And so I would say, well, my daughter and her son-in-law aren't paying for this. You know, how do you generate the funds to stay open? And they said, it's not easy. You know, people would prefer to donate to a cure for kids for a disease versus a kid that might be passing away and they're not going to see the return on investment. And you had to look at it completely different. You have to look at the organization, the people, the mission, what they do, how they take care of these kids, and not only taking care of the kid, but the family who's going through some very, very difficult times. One of the things they did is while you're waiting for death, you don't know when it's going to come, but he was still somewhat mobile. They said, hey, we got to put together a bucket list for Benny. Benny needs a bucket list. He's 5 months old. And I'm like, he's dying. No, forget it. We got to put together a bucket list. So Benny's bucket list was he got to go swimming with his dad. He got to go on the playground with his mom. Grandpa had just bought a Jeep, so we got to go four-wheeling in the parking lot. The therapy dog came in, and just there were a lot of cool things happening that really got the family off of thinking about the bad things that were going to happen, but all the really cool things that were happening when that happened. A newspaper reporter in Oregon caught wind of it and called my sister, who had heard about, well, my sister was there, at times, talked to my sister about it, and she was just blown away with what had happened. She was very big in hospice care in Oregon, and she was a reporter. She wrote an article, it was called Benny's Bucket List, went through everything I just kind of told you, published it, and she was getting hits back from Saudi Arabia, England, Ireland about, what a cool place this was and how they really helped this family in a very difficult time. Benny passed, and that was very difficult, but as I walked away from it, I told myself, you know, I got to do something for this organization. They asked for nothing from the family. They gave everything they could to make the family's experience much better than it could have easily gone the other way. So when I walked out of there, I just told my wife, we got to do something so we can give to this foundation. And I was pretty lucky early on in my professional career when we had sold the company and I had some stock and it was going to appreciate. And I set up that charitable remainder trust, which was just talked about. And I did the simple things. I did the Arizona tax credit. I went to the walk. I got my company foundation to help out. But I think the big impact that my wife and I will make when we're gone will hopefully be the big check that they get from our charitable remainder trust. And I think that's the giving that really makes a difference in the long run. You know, a lot of the little ones are nice, and I'm sure the organization appreciates everything. But to be part of a charitable remainder trust or one of the trusts that was just discussed about will make all the difference in the world for this organization. And that's my story. Thank you.
Thank you, Mark. I am going to stop sharing my screen so you'll be able to see us all again. And we can take some questions. Do we have any questions? I see the list of participants. I find it hard to believe there are no questions. Panelists, while we give them a minute to type, is there anything that you can think of that maybe we forgot to talk about?
I think
I think we covered a decent amount today. There's always more that we could cover, and I think everybody's situation is unique and individual. I'm sure any of the panelists here would be happy to speak with anybody afterwards if you want to discuss your specific situation. If you have, questions maybe you don't want to ask in a group atmosphere, but want to, dig in a little bit deeper, I'm sure any of us would be more than happy to talk to you and work together for you and for Ryan House.
Yeah, I agree. I think we scratched the surface with what we talked about today, but planned giving can be such a creative area that if you have the intent and the desire to help your favorite nonprofit, there's a world of options to consider and much broader than what we talked about today. Today covered some of the more popular ones, some of the more common ones, but it can be a very creative area. So if you have that intent, but you're not quite sure how to do it, what to do it, when to do it, what assets to use, again, as Lisa said, feel free to reach out to any of us on the panel and we would be happy to help you with that.
Perfect. I don't see any questions. Oh, I see one thing in the chat. Let me just make sure.
I agree, Lynn. I agree completely. It does get a little confusing.
And that's from the retired accountant. So, well, I do want to thank all of our panelists again for giving of your time today. We've been working over the last couple of weeks. I truly appreciate it, and all of the knowledge today that you shared. And to all of our participants, thank you for joining us. And thank you everyone for your support of Ryan House and for helping us to kick off our Open Hearts Legacy Circle. More to come, and we truly appreciate everyone today. Everyone take care, be well, and be safe.
Thank you.
Thank you.